everybody. My name is Mike Corbett, and I'm the Treasurer of the St. John Region Chamber of Commerce, and it is my honor to introduce to you Tiff Macklem, Governor of the Bank of Canada, for our Leaders, Innovators, and Influential Speakers Series luncheon. Tiff Macklem was appointed Governor of the Bank of Canada effective June 3rd, 2020 for a 7-year term. As Governor, he is also Chair of the Board of Directors of the Bank and a member of the Board of Directors of the Bank for International Settlements. He is Chair of the Group of Governors and Heads of Supervision, the oversights body of the Basel Committee on Banking Supervision, and co-chair of the Financial Stabilities Board Regional Consultative Group for Americas. Mr. Macklem first joined the bank in 1984 and returned in 1989. He occupied increasingly senior positions in what is now the Canadian Economic Analysis Department until his appointment as chief in January 2000. He was appointed advisor to the governor in August 2003 and made a deputy governor in December 2024. During the 2008-2009 global financial crisis, Mr. Macklem was Associate Deputy Minister at the Department of Finance Canada and represented Canada at the G7, G20, and Financial Stability Board. Mr. Macklem returned to the bank in July 2010 when he was appointed Senior Deputy Governor. In July 2014, Mr. Macklem assumed the role of Dean of Rotman School of Management at the University of Toronto. During his time at Rotman, he frequently spoke about the global financial system, risk management, and public policy. Before becoming governor, Mr. Macklem served as a director of the Bank of Nova Scotia and chair of its board risk committee. He was also chair of Ontario's panel on economic growth and prosperity, the federal expert panel on sustainable finance, and the Global Risk Institute in Financial Services. Born in Montreal, Quebec, Mr. Macklem graduated from Queen's University in 1983 with a bachelor's degree in economics. He completed a master's degree in 1984 and a PhD in economics in 1989, both from the University of Western Ontario. Please join me in welcoming the Governor of the Bank of Canada, Tiff Macklem.
Well, thank you, Mike. Look, it's a real pleasure to be here in St. John. One of the most important and most rewarding things I do as governor is travel across this country. It's a great, vast country, and it is wonderful to be able to hear firsthand and see firsthand how our economic policies are impacting the region, get your perspectives on what's going on in the economy and what we can do to make things better. So a big thank you to the St. John Region Chamber of Commerce for having me. It's wonderful to be here today. I am very much looking forward to hearing from you regarding what are the opportunities, what are the obstacles facing your businesses, as well as I said about your perspectives on the economy. And Mike and I are going to have a little Q&A afterwards, and I'm very much looking forward to that discussion. I know that for many people, high inflation has made life hard. We hear it at the Bank of Canada in our surveys of consumers, and I hear it directly from Canadians. I get a lot of letters, I get a lot of emails from Canadians. And too many of these are about the impossibility of keeping up with higher prices. I hear the worry, I hear the frustration, I even hear the desperation in these letters. I also hear from businesses that are being squeezed by higher costs, and I hear from workers that need higher wages to keep up with the rising cost of living. Nothing concerns me more than the pain that high and volatile inflation is causing for so many Canadians and the broader costs it's imposing on the economy. Inflation has come down from its peak of 8.1%, but it is still too high, and progress has been slower than we'd hoped. And I know that even as our interest rate increases are bringing inflation down, to many Canadians, they feel like just another added cost. Ce qui me préoccupe le plus, ce sont les difficultés de la population canadienne connaît et les coûts de l'inflation élevés et volatiles pour notre économie. L'inflation a baissé depuis le sommet de 8,1 %, mais elle reste trop élevée et les progrès sont plus lents qu'on le voulait. Je sais que même si nos hausses de taux font baisser l'inflation beaucoup, les Canadiennes et les Canadiens les voient comme un coup de plus. Aujourd'hui, je vais vous parler des problèmes que l'inflation élevée fait vivre aux familles, aux entreprises et aux communautés. Les difficultés sont bien réelles et l'inflation ne ralentira pas d'elle-même. C'est pourquoi il est si important de garder le cap et de rétablir la stabilité de prix. On a déjà fait beaucoup de chemin. C'est l'autre sujet que je veux aborder. Ce qui fonctionne et pourquoi. Je vais expliquer certains des avantages qu'on n'avait pas dans le passé pour lutter contre l'inflation élevée. Les taux d'intérêt plus élevés créent des difficultés pour beaucoup des Canadiennes et Canadiens, mais ils atténuent les pressions sur les prix dans toute l'économie. Si on garde le cap, les résultats vont en valoir la peine. By the numbers, the Canadian economy has done remarkably well. The pandemic is now behind us, and workers, consumers, and businesses have all emerged in much better shape than we feared in 2020. After the deepest and sharpest recession in our history, we had the fastest recovery on record. The job market came roaring back, and even though the economic growth has slowed in recent quarters, the unemployment rate is still relatively low at 5.7%. That's where it was just before the pandemic, when times felt good. The worker participation rate is high, particularly for women and newcomers, and many of us have taken advantage of new ways of working and new workplace flexibility. Many households have added to their savings despite the rising cost of living. But Canadians are not feeling happy. I hear this firsthand. We hear this in our Canadian Survey of Consumer Expectations. We see it in other consumer confidence measures and surveys of public sentiment. Usually, consumer confidence is high when the unemployment rate is low. The blue line in this chart is the unemployment rate. The unemployment rate today is lower and the job market is stronger than it has been for most of the last 40 years. But sentiment, the red line, is at a recessionary low as it was during the global financial crisis in 2008, 2009. So why is sentiment so low? Well, there's probably more than one reason. People are weary from the pandemic, public attitudes are more polarized, reducing the sense of common purpose. Technology is accelerating change, making it harder to keep up, and rising conflicts and climate change are increasing anxiety about the future. These causes are all well beyond the reach of monetary policy. But one factor is clearly our responsibility: inflation. People are angry about high inflation. The rise in cost of living is making life harder for everyone, especially Canadians who have less to start with. People are working hard, but their salaries don't buy what they used to. They can't afford the things they need. It feels unfair. And that feeling of unfairness eats away at the fabric of society. There's more disagreement. One metric where we can see this is the amount of time lost to strikes and labor stoppages and work stoppages. The higher inflation in the last couple of years, we're seeing more strikes as employers and workers struggle to reconcile rising costs on each side. Now, nobody wants this. Workers don't want to go on strike, and employers don't want work to stop. But high and unpredictable inflation makes it difficult to agree on fair compensation for work, and that leads to strikes. When inflation is high and volatile, contracts get shorter, negotiations are harder, and uncertainty is higher for everyone. Businesses have also changed the way they set prices for their goods and services, raising prices more often and by larger amounts. That hurts their relationships with customers, raising suspicion and blame. For all these reasons, inflation makes people unhappy. In our most recent consumer survey, almost 9 out of 10 respondents said they feel worse off due to high inflation. Almost no one said they benefit. We're also seeing that inflation is changing people's behavior. We can see in our surveys that families are changing their spending to protect themselves against inflation. They're spending less and trying to find cheaper goods and services. La situation est encore plus difficile pour les Canadiennes et Canadiens à faible revenu. Lorsque les gens dépensent plus pour des produits essentiels, ils ne peuvent pas vraiment ajuster leur achat et ils ont très peu d'économies pour faire face aux hausses de prix. De plus, les prix des produits essentiels comme la nourriture et le loyer sont parmi ceux qui ont monté le plus vite ces derniers mois. Les personnes fixe pension sont encore plus touchées parce que leurs revenus n'augmentent pas pour compenser leur prix plus élevés. On a déjà connu l'inflation et les temps difficiles qu'elle entraîne. En effet, les situations qu'on connaît aujourd'hui nous rappellent des années 70. J'étais moi-même adolescent à cette époque, mais pour ceux qui sont trop jeunes pour s'en souvenir, l'inflation alors était élevée et variable. Elle était restée au-dessus de 7% pendant une dizaine d'années et même atteint un pic de près de 13%. À ce moment-là, tout comme aujourd'hui, des forces mondiales ont fait monter les prix en flèche. En 1973, la crise alimentaire mondiale et l'embargo sur le pétrole ont fait grimper l'inflation rapidement. My impression as a teenager was that inflation was making everyone angry. There were a lot of labor strikes in the 1970s. Many were long and heated. People felt ripped off because they would get what looked like a good raise, but their money didn't buy what they thought it would when they went shopping. To get inflation down in the 1970s, policymakers tried a few things, including wage and price controls and monetary targeting. Monetary targeting means reducing the growth rate of the money supply. Unfortunately, these policies were ineffective. And the government and the central bank weren't willing to stay the course, to restrain government spending and tighten monetary policy enough to wring inflationary pressures out of the economy. So Canadians lived with high inflation for more than a decade. By the time policymakers realized they needed to take more forceful action, inflation was entrenched in the economy. When businesses, workers, and consumers all expect high inflation, it's harder than ever to bring it down. It took very high interest rates and a deep recession to break inflation. In 1981, the policy rate reached 21%, and mortgage rates were even higher. In 1982, the unemployment rate hit 13.1%. That brings me to what's different today, and why I'm confident we will bring inflation back to our 2% target more quickly and at lower cost than we did in the 1970s. We've learned the bitter lessons from that time, and we've got some distinct advantages today. We've got an inflation target, we've got a strong track record of controlling inflation, and we responded forcefully when inflation went up. Let me start with the inflation target. We began inflation targeting more than 30 years ago. Since 1985, our inflation target has been 2%, the middle of the band of 1% to 3%. Between then and when the pandemic hit in 2020, inflation averaged 1.9% and was within the band 80% of the time, a remarkable success compared to the 1970s and 1980s. For more than 25 years, Canadians benefited from low, stable, and predictable inflation. People understood that when inflation got too high, we'd raise our policy rate and slow demand. And when inflation slumped, we'd lower our policy rate to stimulate demand and growth. That track record and stability allowed households and businesses to budget their spending and savings, confident that their purchasing power would not diminish substantially. Canadians came to expect that prices overall would rise only about 2% a year. As a result, competitive forces in the economy were working. Businesses were cautious about raising their prices, and there was less disagreement, fewer strikes, and less labor disruptions. And the economy was more stable and better able to withstand adverse shocks. That track record matters. Even though inflation rose above 8% last year, and even though it is still above our target, long-term inflation expectations have remained well anchored. It's not all smooth sailing. Expectations for near-term inflation rose with inflation, and they have been slow to come down. And I'll admit this is a concern. We do want to see shorter-term inflation expectations decline to be reassured that we're heading back to our 2% target. But the fact that longer-term expectations remain consistent with the 2% target means Canadians believe that we will bring inflation back to target, as we have for 30 years. The 1970s showed us that the very high cost of entrenched inflation, and we know we need to avoid that danger this time round. That brings me to the second advantage we have. This time, we responded forcefully to high inflation from the start, and we are resolute in our commitment to complete the job. We began increasing interest rates in March 2022 and raised our policy rate more than 4 percentage points in 8 consecutive steps, including a 100 basis point increase in July of 2022. After our rate increase in January this year, we paused to take stock. We were clear when we held our policy rate steady in March and April that we were using this pause to assess whether we had raised interest rates enough to get inflation back to target. When we saw the downward momentum in underlying inflation stall, we raised our rates twice more in June and July, bringing the policy rate to its current 5%. This tightening of monetary policy is working, and interest rates may now be restrictive enough to get us back to price stability. But if high inflation persists, we are prepared to raise our policy rate further. By responding forcefully, we've cooled our overheated economy and taken the steam out of inflation. We also move quickly to avoid the need for even higher interest rates later, because experience has shown that the slower monetary policy adjusts to high inflation, the more tightening will ultimately be required. This is what happened in the 1970s. Slower action meant even higher interest rates and a sharp economic slowdown at the end. We don't want to repeat that mistake. Economic growth has slowed, and with GDP growth GDP growth has been near zero for the last several months. So now the economy is approaching balance, and inflation has fallen from 8.1% in June of 2022 to 3.1% last month. We expect the economy to remain weak for the next few quarters, which means there's more downward pressure on inflation in the pipeline. In short, the excess demand in the economy that made it too easy to raise prices is now gone. We know that the higher interest rates that are working to bring inflation down are making things more difficult for Canadians, and slower growth doesn't feel great. But the alternative, years and years of high inflation and then a deep recession, would be a lot worse. When we get through this period of slow growth and inflation is back to the 2% target, Canadians will once again be able to budget and invest with confidence. Prices will be stable and predictable, and the economy will work better for everyone. It's time for me to conclude. The past 2 years have been a painful reminder of how much high inflation hurts households, businesses, and communities. It's our common enemy, not only because it creates financial pain and social upheaval, but also because no one wins when inflation is high and volatile. We all want to see high inflation defeated. La plus grande leçon qu'on a tirée des années 70 est que pour faire baisser l'inflation, on ne peut pas faire des choses à moitié. Accepter de vivre avec le stress, les conflits de travail et l'incertitude que l'inflation cause serait une grave erreur. La bonne façon de réagir est de s'engager fermement à rétablir la stabilité des prix. Mais on ne veut pas aller trop loin dans l'autre sens parce qu'on essaie de ne pas répéter la même erreur. On essaie d'équilibrer les risques d'un resserrement trop faible ou trop fort. Si on en fait trop, on risque de plonger tout le monde dans une situation économique difficile. Si on ne fait pas assez, les Canadiennes et les Canadiens vont continuer de subir l'impact de l'inflation élevée et on pourrait être obligé de relever les taux d'intérêt encore plus à l'avenir. Pour que la croissance se stabilise et que l'inflation reste basse dans les années à venir, on a besoin des taux élevés et d'une croissance lente à court terme. Notre cible d'inflation, nos résultats jusqu'à maintenant et nos mesures vigoureuses vont nous permettre de traverser cette période difficile. On est sur la bonne voie et on doit maintenir le cap. The lesson from the 1970s is that fighting inflation half-heartedly and living with the stress, the labor strife, the uncertainty inflation causes would be a huge mistake. The right way to respond is with a firm commitment to restoring price stability. But we don't want to avoid one mistake only to overdo it on the other side. We are trying to balance the risks of over and under tightening. If we do too much, we risk making economic conditions unnecessarily painful for everyone. If we do too little, Canadians will continue to endure the harm of inflation and will likely have to raise our interest rate even higher. To return to low inflation and stable growth in the years ahead, we need these higher interest rates and slow growth in the short term. Our inflation target, our track record, and our forceful response will get us through to the other side. We're well on our way, and we need to stay the course. Thank you very much.
Thank you, Tiff. So questions. I have a handful here now, but there's not necessarily enough to be able to get us through the next part. So please feel free to pencil something down. The staff are in the back and are happy to stop by your table and pick them up and hand them to me here. So let's begin our Q&A session if we could. We'll also be ending at exactly 1:25. So you're only in the hot seat so long. So okay. So I've got some great questions in front of me so far, Tiff. Thank you very much, by the way. The first question is can you help us understand why central banks are struggling to accurately forecast inflation?
Well, I don't think it's that complicated. But you all run businesses. You all work in businesses. I mean, you've all experienced unprecedented volatility over the last 3 years. I mean, our economy went through the deepest recession on record, the fastest recovery. We've had supply chain disruptions. We've got wars. So much of what has happened in the last 3 years is really outside of our historical experience. And with all that volatility, yes, it's been harder than usual to forecast almost everything. With respect to inflation, look, I'll be very candid. We were surprised coming out of the pandemic by the burst of inflation. We did expect inflation would rise, but we definitely underestimated how much and how quickly it rose. And I think there are a couple of lessons from that for us. The first is it's a lot easier to restore demand than supply. Demand came roaring back, but supply just could not keep up. as I say, you run businesses, just trying to hire enough people after you'd been closed multiple times, that took time. That took time to train people. At the same time, globally, supply chains were clogged. You were getting delivery, your deliveries were uncertain. You were having to buy more inventory. All those things added to your costs. Demand was strong. Those got passed on, and prices went up much more rapidly. The good news is, we got on it relatively quickly. We raised rates forcefully, and it's working. Inflation's come down from 8, came out at 3 yesterday. We're not there yet, but we're certainly well on our way.
Thank you. Tiff, is there anything that the Bank of Canada could have done better to combat this?
Look, I get asked this question a lot of time. Of course there's things we could have done better. I think every one of you running your businesses, there are probably things you look back and think, oh, I could have done that a bit better. As I said, I think to a large extent this inflation, it certainly started globally. We're a very open economy. It was a big part of it was imported. It certainly has become more domestic with the very strong recovery here. We've worked hard to get inflation down. I do think there are some lessons. I mentioned one of them. It's easier to, we underestimated how difficult it would be to get supply to come back. Historically, supply has responded more with demand. We underestimated that. I do think there are some lessons we have to learn. I think another lesson that we've learned or relearned is that, for much of the last 10, 12 years, our economy actually wasn't overheated. It was pretty stable. So we've had lots of supply shocks in the past, but when your economy's not overheated, they've had relatively temporary effects, and they haven't really done much to inflation. But I think one thing we observed is when your economy is overheated and you get a negative supply shock, it does translate into more inflation. So yes, there are lessons that I think that we have to learn from this episode. But I would underline, I do think we got a lot of things right, and I think we're well on our way in getting back to price stability.
Perfect. What are your thoughts on limiting U.S. influence on the economy here?
Well, if it's a more political question, I'll just avoid it. As interpreting it more as an economic question, look, the U.S. is by far our biggest trading partner. 75% of our trade is with the United States. This region is very linked to the United States. To be frank, Canada's very lucky to be situated right beside the biggest economic engine in the world. It's a great benefit to Canada. We always have our differences. We always have our trade spats, but actually we have, with USMCA, we have, a very good trade agreement with the United States. We have very open capital markets with the United States. It's a big benefit to Canada.
Exactly. Given the high value of assets, real estate, stocks, etc., are you concerned that the next decade may be considered a lost decade to allow the economy and values to catch up?
Let me begin by saying I don't give investment advice. No, I'm not expecting a lost decade. I think we've been going through a difficult period. We actually need a period of slower growth that we have right now to relieve these inflationary pressures, to get inflation down. It's working, and as we get through next year, I think we're expecting later next year, inflation will be getting down closer to the target. Growth will be picking up. Look, longer term, we have a number of advantages as a country. We do have some challenges, and we can get into that if you want, but look, whether you're running the country, you're running a business, you need to double down on your strengths and manage your weaknesses.
Understood. What specific economic indicators or measures will the Bank of Canada need to see in order to decide when it's time to cut the interest rates?
Well, that is certainly the question everybody's asking. Let me say two things. Yesterday's CPI number was certainly encouraging. We expected inflation to come down. It did come down, and that is certainly good news for Canadians. I would stress that in the last number of months, we've seen a fair amount of volatility. We've been down to 3.1% before. In fact, last June we were 2.8. It went back up to 4 in August. We're pleased to see it come back down. So there's some volatility, and if you look at sort of the underlying trend or core inflation, what you see is, through the summer into the early fall, it was pretty much going sideways. The number yesterday ticked down a little. That's a good sign. What we're really looking for is we're looking for clear evidence that core inflation, underlying trend inflation, is down. And as I said, it's been, underlying inflation's been running around 3.5% for some time. There's a little evidence it ticked down yesterday, but look, 1 month is not a trend. We need to see, a number of months to see clear evidence that we're on a path to 2% inflation. When we see clear evidence that we're on that path to 2% inflation, that will be a time to start thinking about cutting interest rates. Right now, it is not time to start thinking about cutting interest rates. We're not, that evidence is just not clear enough yet.
Understood. With many Canadians already feeding into that, with many Canadians already struggling with the impact that high inflation has on their discretionary spending, how concerned are you with the large number of residential mortgages that are coming up for renewal, and that there are many Canadians that won't simply be able to afford a significant increase to their monthly payment?
Look, we are acutely aware of the mortgage renewals. So right now, about 40% of mortgages have reset, which means there's about 60 left. Your typical mortgage in Canada is 5 years. There's about 15% are variable rate. And so every month, yes, more Canadians are renewing their mortgage, and when the reset is substantial, and that is squeezing Canadians. It means they've got less income to spend on other things. That is partly how monetary policy works. That is what is reducing spending, and that is what's actually bringing inflation down. So, as I said, we don't want to overdo it. We don't want to squeeze more than we have to. We don't want to make this any more painful than we have to, but we are determined to get inflation down. So we are watching that renewal process very carefully. So far what you see is that Canadians are paying their mortgages. Is it more difficult? Yes, it's more difficult, and that's getting inflation down. It's working, and as I said, when there is clear evidence that we don't have to wait until inflation is back to 2% before we cut interest rates, but we do need to wait until it's clear that we're on that path to 2% inflation. And when we're there, we can start thinking about reducing interest rates.
Understood. You'd mentioned the 70s in your speech, and here's the question as it's read: as some of us remember the stayflation of the 1970s, are you concerned about the low growth, higher inflation phenomenon?
Well, yes. The word yes. As I said, I was a teenager in the 70s, and the two words were stagflation and the misery index. The misery index was the sum of the unemployment rate and the inflation rate. There are some similarities today to what we had in the 70s. Burst of inflation, and unfortunately today, there's a whole generation of Canadians that is relearning just how harmful inflation is for the first time. There are some important differences, though, as I highlighted. And what those mean is I am confident that we're going to get inflation down much more quickly than we did in the 70s at much less cost. So, yes, we do need a period of slower growth. We're not predicting a deep recession. We've got very subdued growth. We actually need subdued growth to get inflation down. And as inflation comes down, growth can pick up. So it's not going to feel good, but it's not a recession.
Okay. So a welcome question outside of just inflation is, when will we have a fully functional digital dollar?
Two things I'd say there. First of all, banknotes, cash, is not going away. Canadians like to use cash, and they will be able to continue to use cash. Now, whether we have a digital dollar or not ultimately actually is a decision for Parliament. It's not a decision taken by the Bank of Canada. What we are doing at the Bank of Canada, though, is that we are getting ready for the possibility of a digital currency. The economy, I mean, I don't need to tell you, you're all running businesses. Economy is becoming increasingly digital. There are more digital payments options. And at some point, it may make sense for Canadians to hold central bank currency in a digital format, just like they hold central bank currency in a physical format. So we're getting ready for that possibility. There are a lot of policy questions related to that. How would that work? What impact would it have on the financial system? What do Canadians want in a digital currency? Actually, we've recently surveyed Canadians to get out their attitudes about a digital dollar. And we'll actually be publishing the results of that fairly shortly. But just to preview it, I mean, one of the things, not surprisingly, you hear from Canadians is very concerned about the security and the privacy that would be involved in a digital dollar. So those are the types of things we're looking at. And we've certainly got some work to do. And as I said, ultimately, it's a decision of Parliament.
Okay. How will increase in wages of union groups impact the go-forward inflation? Is it material or significant?
So first thing I want to stress is that we really like to see higher wages. That's higher incomes. That's good for Canadians. But what we want to see is that those higher wages come with higher productivity growth. Higher productivity pays for higher wages. So when we look at wage growth, we're really looking at wage growth relative to productivity. Right now, wage growth is running around 4 to 5%. The labor market, which was quite overheated, we were experiencing a large number of labor shortages. Companies were having a very hard time finding enough workers. The labor market has come back into much better balance. It's probably still slightly on the tight side. Depends a bit on the sector. It depends on the type of worker. But on balance, it's probably still slightly on the tight side. But if you look at vacancies, they've come down. They're still a little above normal, but they've come a long way back. The unemployment rate has moved from very low levels back up to 5.7. So you're seeing that adjustment. And with that adjustment, we expect to see some deceleration of wage growth. And the reason is that wage growth at 4 to 5%, unless we see a big pickup in productivity growth, that's not consistent with 2% inflation. So we are looking for some gradual easing in wage growth. We're also looking for some pickup in productivity growth. Together, those will bring unit labor costs down more in line with our inflation target. So that is something we are watching for.
Thank you. Just time for another couple more questions if we could. Beyond interest rate adjustments, what tools does the Bank of Canada have to make monetary policy? Have they been used to reduce inflation properly, and if so, how?
Our interest rates really are our primary tool. When the economy is really weak and inflation is falling, we lower interest rates, stimulate the economy, support the economy, and push inflation back up. And as you've all seen recently, when the economy is overheated, inflation's rising, we raise rates. That's our primary tool. We do have some other tools that we use more in exceptional emergency circumstances. So during the pandemic, when our interest rate was as low as it could go and we couldn't lower it anymore, we used something called quantitative easing by government bonds in scale, which pushes interest rates further at the yield curve down. Now we are unwinding that. We're doing something called quantitative tightening. So our balance sheet is shrinking, which on the margin tends to push longer-term interest rates up a little bit. But I would really stress that our primary tool is our policy interest rate.
Understood. How big a factor are gas and fuel prices as opposed to excessive consumer spending on inflation?
Well, certainly energy has been a big part of the inflation cycle we've seen. Energy prices were going up already as the global economy was coming out of COVID very quickly. And then, of course, Russia's unprovoked attack of Ukraine boosted global energy prices dramatically. That was an important reason why inflation went up to 8%. And as energy prices have eased, that has been an important factor bringing inflation back down. We don't, although we are an oil producer and certainly oil's important locally, oil in Canada is priced at the global price. And so our consumers pay the global price, and when global prices go up, that shows up very quickly in CPI inflation. It shows up very quickly at the gas pump, in your heating costs, so it shows up very quickly in inflation. That's not something we can control, and to the extent that it's not feeding through into other prices and wages, it's something we largely look through. There's going to be volatility in oil prices. What we're more focused on is underlying inflation, our measures of core inflation that tend to strip out the volatile components, which is often oil, because that gives you more of a sense where what's the underlying trend in inflation, and monetary policy works with a lag, so you don't want to overreact to every movement. But I will say, if what we're worried about are the second round effects. So if oil prices were to go up a lot, particularly against a background where we've been above our inflation target for 2 years, we would be particularly worried about the second round effects. If oil prices go up, transportations go up, that starts to show up in the prices of other goods and services. That would certainly be a signal of trouble for us. Hopefully that doesn't happen.
In your opinion, what is the biggest misconception the public has on the Bank of Canada and the job it does?
That's a good question. One thing I think, and we're trying to do a better job of explaining it, is I think everybody understands they don't like high inflation. People don't like higher interest rates either. I think one thing we're trying to explain more clearly is the link between how higher interest rates get inflation down. And then once inflation is down, interest rates can come down too. But we do need this period with higher interest rates, with slower growth, to get inflation down. It's not going to come down by itself.
Thank you. Last question. Sorry, there's many more here, and these are great. And I wish I had you for another hour, but I'm sure sitting in a hot seat for an hour is not overly attractive to you. But to wrap up the session, the question that came forth, what advice do you have specifically for business, but not just business in general, but business in New Brunswick? What advice do you have for the membership here on how to survive, how to succeed during these tough economic times? What specific advice do you have?
Look, I hesitate to give business advice. You know your businesses much better than I do. But I think just a few sort of general comments about what we're seeing. Canadian businesses have shown incredible resilience and innovation through the pandemic. You quickly figured out how to serve your customers, how to get your employees to work from home. This pandemic would have been so much worse if it was not for the resilience and the ingenuity of businesses. And as we have come out of the pandemic, we're not talking about pandemic level challenges, but yeah, there are new challenges. And if I was to offer one bit of advice, take some of that spirit of innovation and ingenuity and apply it, every day. We have some amazing companies, highly productive companies in this country that are competing extremely effectively in the global marketplace. Wouldn't it be great if we had a few more? And I think if we bring that spirit of innovation, that desire to figure out how to drive out cost, how to create new products, how to expand new markets, we will have more world-leading companies.
Well, thank you very much, Tiff. Well, and thank you on behalf of the Chamber of Commerce for coming to St. John to share your message, to bring the message of the Bank of Canada and informing us right directly from you. So I'd also like to thank today's Speaker Series sponsors, Envision St. John, Emera New Brunswick, Liberty Utilities, University of New Brunswick St. John MBA program, CHSJ Country 94 and 97.3 The Wave, and Fusion St. John. Thank you all for attending, and this meeting is now adjourned. Thank you.
Good afternoon. My name is Rebecca Spence, Press Officer for the Bank of Canada, and I will be moderating this press conference. Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you. We also have some journalists participating remotely today, so we'll do one question in the room first and then turn to the call to try to make sure every outlet gets a chance to ask a question. The Governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. So we're going to start in the room with John here.
Hi, John Schillebeck with the Telegraph-Journal. You mentioned in your speech today that in the 1970s, two big mistakes were made to tackle problems in the economy and inflation. You said that the Bank of Canada wasn't aggressive enough in imposing measures, but you also mentioned that Ottawa wasn't restrained enough in spending. So right now, is the federal government restrained enough in spending to avoid these problems?
Well, yesterday, obviously, you saw the federal government put out the fall economic statement, and I'm not going to comment on specific fiscal measures, and I'm not going to give a running commentary on federal and provincial economic updates. I don't think that's helpful for the Bank of Canada's independence. It's not really our job, and there's lots of people to comment on fiscal policy. Fiscal policy is appropriately the responsibility of elected governments and ultimately parliaments. The fall economic statement does provide a fiscal update relative to the budget that was earlier in the year. And over the next 2 years, what you see in the fall economic statement is that the budgetary balance is little changed relative to what it was in the budget earlier this year. So what that means, it's not adding or subtracting over that horizon. So from the perspective of monetary policy, the fall economic statement suggests that the government is not adding new or additional inflationary pressures over the next couple of years, which is the critical period over which we will be looking to reduce inflation and get it back to the target.
We'll go next to Brad.
Hi there, Brad Perry with Acadia Broadcasting. You mentioned during your remarks earlier that, in order to be able to reduce the interest rates, we need to wait until we're on a clear path at 2% inflation before making that step. And I mean, that has a lot of Canadians wondering, when do you expect we will be at that point where we'll be able to start lowering those interest rates and getting back to that balanced path?
Well, I'd love to be able to put it on a calendar for Canadians, but I think that that would risk giving a false sense of precision. I think qualitatively, what we can tell Canadians is that we don't need to wait until inflation is back to 2% before we start lowering interest rates. Monetary policy works for a lag. With a lag, it takes time to work. So you do want to start to anticipate where you do want to anticipate where inflation is going to be. And so when we are confident that inflation is clearly on a path back to 2%, it will be time to start having that discussion about whether to cut interest rates. Right now, look, yesterday's number is good news. It's good news for Canadians. Inflation came down. But you do need to keep in mind we've seen a fair amount of volatility in inflation. It was down actually a little below 3% in June. It went up to 4%. It's come back down. So there is volatility. What we're really looking at is the underlying trend in inflation, and we particularly use our core measures to look at that. And they've been running for the last number of months 3.5 to 4. Yesterday, they came out around 3.5, so they're very much in the lower part of that range. And if you look at 3-month rates of core inflation, which are sort of more indicative of recent experience, that's running around 3. But again, they're volatile, and 1 month is not a trend. So when we see a clear trend that we're clearly going back to 2, it'll be time to start discussing whether it's time to lower interest rates. Right now, really, we're still assessing whether interest rates are high enough. They may be high enough. They may be restrictive enough to get us back to where our 2% target. But getting back to the previous question, the lesson from the 1970s is you don't want to be half-hearted in your efforts to get inflation back to target.
Thanks, and we'll go to Grant.
With the CBC. You previously said governments were not rowing in the same direction as monetary policy. Does this update start to do this?
Sorry, can you just say the last part again?
Sure. Does this update start to do this? Get governments going in the same direction?
Look, the fact that the budgetary balance so in yesterday's fall economic statement, the budgetary balance for 23-24 and 24-25 is essentially unchanged from what it was in the budget. And that is helpful as we work to get inflation down over, through next year and into 2025. The other thing a couple other things in the fall economic statement, beyond 24-25, there is some additional spending. We will be building that into our outlook, and if there are any other provincial updates, we'll be building that into our outlook, and we'll be publishing a new economic outlook in January that will build that in. The fall economic statement also includes some new fiscal guardrails beyond the near term, and from the perspective of monetary policy, I do think that's helpful.
All right, we're going to go to the call now. I just want to remind people on the call to mute their line if they're not asking a question. So we're going to start with Max Sato from Mace News, followed by Josh, then Randy. So go ahead, Max.
Thank you, Governor. My question is, service prices seem to be sticky for the CPI, but if higher service costs are mostly coming from higher wages, would that be a good thing for households?
Well, if you look at the inflation numbers, you're right that service price inflation is high, 4.6%. Most of that's coming from shelter. Actually, if you take services ex shelter, inflation's only 2.3%. So I think that's what that's suggesting is you're not seeing a great deal of evidence that higher wage growth, so far anyways, is passing through into higher service price inflation. Yeah, I don't think I have much more to add on that.
We'll go to Josh Rubin of the Toronto Star.
Sir. Hi, Governor Macklem. Thanks for taking my questions. It's a bit of a two-parter. First, do you think in retrospect announcing the conditional pause was a mistake? Because I mean we saw what happened with the real estate markets taking off like that because people interpret it as rate cuts were just around the corner. And I guess second, would you agree that we're effectively in a conditional pause right now?
Okay, you're right. Two-parter. So on the first part, look, I'm going to let other people judge the wisdom of our monetary policy decisions. Look, my own view is that the pause made a lot of sense. We had raised interest rates from near zero to 4.5% in a very short period of time. It was actually the most rapid tightening of monetary policy in history. It made sense to pause and let those rapid rate increases feed through the economy and assess whether we'd done enough. We paused for 5 months. After that, as we got later in that period, it started to become clear that monetary policy wasn't restrictive enough, and so we raised rates 2 times over the summer, up to 5%. I think, look, there's always going to be a certain amount of uncertainty about how quickly, how strong the traction of monetary policy is going to be, and you want to manage that. We don't want to do more than we have to. We don't want to slow the economy more than we have to. At the same time, we are committed to getting inflation back to the target, and we're prepared to do what's needed. And when it became clear that monetary policy wasn't restrictive enough, we elected to move rates up again. Since you're right, the last 2 meetings we have held our policy rate at 5%. We are taking it very much 1 meeting at a time. As I've said previously, monetary policy may be sufficiently restrictive. Interest rates may be high enough to get inflation back to target. Yesterday's number was certainly encouraging, but 1 month CPI is not a trend. We need to see sustained evidence that underlying inflation is coming down to be more confident. If we see inflation back up, if we see underlying inflation's running around 3%, if we see that persists, that is still well above the target. There may be a need for higher interest rates. We're taking it 1 meeting at a time.
Thank you. We'll go now to Randy Thong Knight from Bloomberg.
Good afternoon, Governor. In the last set of published deliberations, there was mention of a debate between council members on whether the bank should hike or hold. Were you on the side that wanted rates to move higher? And if not, how did you convince the more hawkish members that holding rates steady was the best course of action?
Randy, I was on the side of the consensus. Let me just clarify a little bit your characterization. So, what I would say is that the summary of deliberations is it's just a very straight up summary of what we discussed. And when members of the governing council looked forward, some members were of the view that, look, I think nobody's got a crystal ball. Nobody knows how the date is going to turn out. But some members were of the view that, well, on the balance of probabilities, they felt the balance of probabilities was more likely that rates would have to go up further than stay where they are to get inflation back to the 2% target. Other members felt, looking forward, monetary policy probably was sufficiently restrictive, and balance of probabilities were that we wouldn't have to raise rates further. Everybody agreed that given the clear evidence that the economy had slowed, that it had entered a period of slower growth, that growth was likely to be slow for the next few quarters, and this should further relieve price pressures, there was a clear consensus to hold the policy rate at 5%. What do I think, what should you take away from that? I think what you should take away from that is that monetary policy may be sufficiently restrictive to get inflation back to target. There is, understandably, when you're at one of these critical points, some diversity of opinion across the governing council. That's a good thing. That makes sure we're looking at this from different angles. There's a clear consensus that we need to hold, and we'll be taking it 1 meeting at a time going forward.
So we'll go next to Mark Rundle from the Globe and Mail, followed by Reuters and the Canadian Press. Go ahead, Mark.
Thanks. I want to follow up on your response just then to Randy's question. You said you were on the side of the consensus and then went on to describe the consensus as, hold in the short term. But I guess it seems like the split was between whether interest rates on a balance of probability would be more likely or not. And I'm wondering if you can explain, what do you mean when you say you were on the side of consensus? Is that you were part of the camp arguing that rates would likely remain steady, or in the camp that was arguing rates would likely need to rise?
Mark, I really don't think I have much to add to my previous answer. I think, as I said, the summary of deliberations, it's pretty self-explanatory. It's a straight up summary of what we discussed. There was a clear consensus to hold, and I think the reasons for that are very clear. The Governing Council all felt we could be patient, wait for more data. If that data indicates that we need to raise interest rates further to restore price stability, the Governing Council is prepared to do that. If the data comes in, if inflation keeps coming down, if we see underlying inflationary pressures ease, we probably won't have to raise rates further. The consensus was we should be patient, let that data come in, and take that assessment one meeting at a time.
We'll go next to Steve Schreier from Reuters.
Hi, Governor. Thanks for taking our questions today. I wanted to pick up on a line that's in your speech today. It says, many households have added to their savings despite the rising cost of living. And I was wondering if you could give us any illumination, I guess, as to why people might be saving right now. Are they worried? I guess my thought is, are they worried about renewing their mortgages, and so you're sort of anticipating kind of double whammy, first inflation and then their mortgage rates going up? They're putting some money back now. Do you have any insight into that?
Well, let me answer that in two parts, and the first part will be more factual, and the second part will be a little more speculative. So the additional savings really goes back to COVID. So during COVID, households couldn't buy many of the services they wanted to buy. They couldn't go on vacation. They couldn't go to a restaurant. And so they didn't spend as much as they normally do. And so they accumulated what economists sometimes called excess savings. They saved more than usual. And as we've come out of COVID, what we've seen is that Canadians' spending patterns have gone back to normal, but they haven't overall spent much of that additional savings that they saved during the dark days of COVID. So that's just, and interestingly, Canadians are somewhat different than Americans in that respect. Americans, like Canadians, did save more during COVID for all the same reasons, but Americans actually have spent most of that additional savings, whereas Canadians have not. As I said, Canadians' spending patterns have gone back to normal, but they haven't dipped in a significant way into that savings. So then the more speculative part is, okay, so why is that? And look, I think there are many different reasons. Some households are paying down debt. Some households have invested the money, and I think you're probably right. I think some households are looking forward, and they're seeing, boy, when my mortgage resets, it's going to cost me a lot more. So I better park some of that money for now, so that I can absorb the higher mortgage costs when my mortgage renews.
We'll go next to Najud.
Hi, Governor.
Hi, Najud.
Your speech talks about inflation being entrenched in the 1970s. But today, we're now at 3.1% for inflation, less than 2 years since you started raising interest rates. So I'm wondering if you still see a risk of inflation becoming entrenched in the Canadian economy.
Well, Jude, as I outlined in the speech, So far, longer-term inflation expectations have remained reasonably well anchored on the 2% target, and that certainly is very positive, and I think it reflects confidence, belief that the Bank of Canada is indeed committed to getting inflation back to 2%, and we will do what's necessary to achieve that goal. Shorter-term expectations of inflation have risen. To some extent, that's not surprising. Inflation was very high. In shorter-term inflation expectations, if you look at our surveys, particularly of households, but also of businesses, they are coming down, but they're not coming down as quickly. Well, put it this way, they're above our own forecasts of inflation. So they're coming down, but they're coming down slowly. So that is a source of concern because behavior is also affected by shorter-term expectations. When you think of people's decisions, what people think inflation is going to be over the next year or two matter for those decisions. So that is something we're watching, and one of the signs that we're clearly getting back to 2% is that those shorter-term inflation expectations keep coming down towards 2%. So to get to your question, if we saw that those shorter-term expectations were stalling well above the 2% target, that would be a sign that expectations that inflation is going to stay higher than our target could be starting to get entrenched, and that would certainly be something that would concern us. We are concerned that those inflation expectations are coming down slowly, and so it's something we're watching, and we need to see those keep coming down. But so far, they have been coming down.
All right, we are almost out of time, but we have two more reporters on the line. So we're going to go to Greg Quinn from Market News, followed by Paul Vieira from the Wall Street Journal. Go ahead, Greg.
Hello, Governor. The federal government is formalizing a so-called charter of mortgage lending, which allows a lengthening of amortization and other relief for borrowers in difficulty. Is there a risk that if people keep getting stuck on repaying their loans, it will alter your inflation fight or introduce some other instability in the financial system?
Greg, I don't have much to say on, specific government actions, but, I will say in general terms, households that are, having real difficulty paying their mortgages are not households that are contributing too much to spending in the economy. So, we don't want, monetary policy is never going to work equally across the economy, and equally across all households, but we don't want it to be any more unequal than it has to be. And to the extent that the people that are, really having difficulty, there's a way for them to work through those difficulties. That's a good thing for everybody.
All right, Paul, go ahead.
Hi, Governor. In the speech, you said excess demand is now gone. I take it then, is spare capacity now building, and how many quarters do you expect spare capacity to build up to a point where you're ready to discuss rate cuts?
Well, on the first part of your question, this was a speech. I spared the readers the long list of indicators that one looks at when one comes to an assessment as to whether the economy is in excess demand or excess supply. I mean, as we indicated at our last decision, a broad range of indicators suggest that the economy is at least approaching, flipping from excess demand to excess supply. Some indicators suggest we're already in modest excess supply. Other indicators suggest there still may be a little of excess demand. I think, and since our last decision, the economic data, growth's been pretty weak. The indicators have not been particularly strong. So, we're either approaching or already in a little bit of excess supply. I think it's hard to be super precise about whether it's a small positive or a small negative. But I think, the message in the speech is that, the excess demand that was really contributing to inflation is gone. We do expect to move into excess supply in our own forecast. We've got, the next few quarters growth is quite subdued, well below potential growth. It starts to pick up in our forecast late in 2024. So we will be moving into excess supply in that period, and then as you get into 2025, that excess supply will begin to be absorbed.
All right, that is all the time we have for today. So thank you all for joining, and thank you to the Governor for participating. Have a good day, everyone.
Thanks very much.